In this video, I am going to share with you 3 number crunching exercise that you have to do in order to invest in real estate. In fact, if you are already investing in real estate and if you are not doing these calculations, then you are probably not able to measure your performance about how your real estate is doing, how your property is performing. These are not rocket science. These are very, very simple calculations. And if you are not doing this, or if you don't even know how these calculations being done, then probably you are an ignorant person in terms of real estate investing. So let's dive into it. The first calculation is called cap rate, or also called as capitalization rate. The way it gets calculated, it's first you have to calculate the net operating income, or called NOI, and divided by your purchase price, the total purchase price. That will give you a cap. So how do you calculate the net operating income? As you see, the net operating income, your total rent minus your operating expenses. Now to do this, I would ask you to assume that you purchase a property fully cash. It means that there is no bank loan. Then what are the income that you get from the property is your rental income. And if you have some 2 weeks vacancy, so I generally calculate about 50 weeks of rental income out of 52. Let's say 500 is your rental return, into 50, that's 25,000 is your total rent, minus your operating expenses. What are the operating expenses that you have? Number one is if you have a rental manager, you have to pay about 6 to 8% of your rental management expenses. The second one is your insurance cost, and third one is ownership cost, which is basically you're holding the property. You have to pay your utility cost, and that will give you your operating expenses. Think about what all expenses that you have if the property that you bought fully by cash. That would be your operating expenses. So total rent minus your operating expenses becoming a net operating income. Let's say 25,000 is your rental return and 5,000 your operating expenses. That gives you a 20,000 of your net operating income. And if let's say the property price total cost is 500,000, that gives you the cap rate of 4%. Why it is important? Because you can compare when you are purchasing a property by knowing how much is your operating expenses will be, how much is your rent will be, and the cap rate is going to give you a comparison of whether the property is going to be a good investment as per your standard, or is this something that is not going to. So if you are looking for 5 or 10 different deals, by doing this cap rate, in a moment you'll be able to see financially how this property or how this deal is viable for you or not. So cap rate is particularly very important when you are purchasing the property, or even when you are selling the property, then you know how it is calculating as well. The higher the cap rate, the better for you. Simple example, let's say 20,000 is your rental return and 500,000 is your property price. That means 4% is your cap rate. Whereas with the same 500,000, if the rental return is 50,000, then the cap rate is 10%. So that means the higher the cap rate, your rental return is more. Hence, you will always look for higher cap rate. If you are looking multiple properties, you can now compare which one is a better performing asset, which one will be a not so better performing asset. So this is how we do calculate cap rate, and it is important. If you are not doing, you must do this cap rate calculation. The second calculation is cash on cash return. How much you are getting the cash back divided by how much cash that you put. That's why it's called cash on cash return. How much cash you are getting back, your bank the bank account statement is going to say NOI you have already calculated, net operating income, minus all your interest expenses. Now if you took 80% loan, then you have a principal and interest amount that every month you are paying, or any other expenses like your accounting expenses or any other expenses that you have, that you need to subtract, and that will give you the cash, how much cash you are getting back at the end of the year. If you are taking interest only loan, then of course your cash return would be more, but if you are doing the principal and interest, then your cash will be a little bit less and it might go even negative. Cash on cash return is an important factor to know how you can sustain, because if you are continuously losing money every year, then you need to calculate how many properties you can buy where you are losing money, and that you need to supplement with your job income or any other income that you have. So you need to calculate that. Cash on cash return, it also depends on what kind of loan structure, how much money you are borrowing. If you are borrowing only 50 or 60%, then cash on cash return will be high because your principal and interest amount will be much less. Whereas if you are borrowing 80 to 90%, then generally speaking that cash on cash return will be much lower, in fact even negative as well. So it is important to know that how much is the cash on cash return, and it's a simple calculation, as I say, how much cash you are putting down and how much cash you are getting back. So cash getting back divided by cash getting down is your cash on cash return. If you find this video is helpful, then please like this video, subscribe my channel and turn the notification bell on so you get to see more videos like this, and the YouTube algorithm helps me to reach out to more people like you. And the third calculation is total profit percentage. You calculate the total profit divided by the cash that you put down. When you calculate profit, then you have your net operating income or NOI, then all other principal and interest expenses that you put, and then you also add your growth, because generally speaking if you are buying a property, then over a period of time it goes up with inflation and with the general property market it goes up. Hence 2%, 3%, 4%, whatever growth that you get, you calculate, and that becomes a profit. Sometimes cash on cash return is negative and it's a negative cash flow, but the growth of the property is more than this cash on return loss. Hence over a period of time you get more. So that's actually gets calculated in total profit, and year after year you can see that how this profit is getting up. It's on paper profit. Unless you sell the property, then you are not realizing this profit, but it's important to calculate to know how your asset is performing. So the total profit is going to give you an indication if you are holding that asset for 5 years or 10 years. On year 1 how much profit is made, on year 2, and you will be able to calculate that and will be able to understand whether you are going to keep this property, how long you are going to keep this property, what's your target profit, and that will give you a calculations and kind of a benchmark to go towards to that direction. Remember, when you purchasing a property, you are going to compare with cap rate. When you already purchased that, year after year you are going to check cash on cash return, because it is giving you oxygen of your property portfolio. If the cash on cash return is negative continuously for all of your properties, then you have to supplement with your income, with your other income, to make sure that you hold these properties, and the total profit will give you that how much you are actually making money over a period of time. I hope you like these 3 calculations, because these are very simple and easy to understand, and I am sure that if you do this, then your asset performance, you'll be able to measure it properly and you know where you are going. Thank you so much for listening. I'll see you next time. Bye bye.